Hi, everybody. We are looking at a problem that I made up uh, about the first month of a company starting. This is J&J Nerds Computers. You've got the narrative on a sheet of paper, and I'm going to show you how it's done both in this column, the tabular form, and also the journal entries. I wanted you to have both of them for your notes. If you don't mind, I went ahead and just set this up with all of them and wanted to go through the transactions with you to save time. I encourage you to perhaps take the narrative and work the problem on your own, and then come back and use this narrative to check your numbers and make sure that you understand what happened. And then, like I said, I've got it in the tabular form. I'll also do it in the journal entry format. Let's look at the tabular form, shall we? We've got 12 transactions. Now, the advantage to the tabular form is we can see after every transaction that the accounting equation stays in balance. And the extended accounting equation, assets equals liabilities plus equity minus withdrawals plus revenue minus expenses, we can see we're going to stay in balance with every transaction. So let's take a look. Okay. The owners invested, number one, the owners invested $10,000 in the business purchasing common stock. Okay. What happened? Remember, we've got to keep the business separate from the personal. So cash went up $10,000, and so did common stock go up $10,000. So we see transaction one, cash goes up, common stock goes up. Okay, we're in balance. The attorney accepted $1,000 in stock in payment for the attorney fees to organize the company. So we see the organization expense. I like to change that to organization costs, so because I didn't want to confuse you with the regular expense. So organization expense, organization costs, what the attorney charged us went up $1,000. But on the credit side here, on the credit side of the equation, common stock goes up $1,000. Okay, we paid the attorney not in cash, but in common stock. Okay. Number three, the owner signed a lease for 12 months for $1,000, $500 a month for the first month's rent, and $500 for the last month's rent, which is quite common. So we wrote a check for $1,000, and the last month's rent went into an asset, prepaid rent. And then the other $500 for the current rent went into an rent expense for $500. What's the difference? The $500 now for the rent expense is current. The $500 in the prepaid rent is not going to be used until the future. So it's currently set up as an asset until we use it, until we consume it. Number four, they bought $4,000 of inventory. So inventory goes up, okay, on account. We didn't pay cash for it right now. So merchandise inventory, an asset goes up, a liability goes up for $4,000. We still owe for the inventory. Guess what? We're still in balance. Okay. The company spent $250 in cash for advertising. So what happened? Cash goes down $250, and our advertising expense. We had a $250 advertising expense. We spent another $300 on a radio station. Guess what? Advertising, again, goes up for $300. And we've got what? A liability goes up for $300. We still owe for that advertising. They did some cash work, number seven. They did some cash work for the customers, $3,000 on revenue, collected $3,000 in cash. Yay, like those cash customers. Okay, we sold a computer for $2,000. They're on number 8. And what happened? Okay, revenues of 2,000, and the owners accepted $500 down and billed the customer for the rest of it. So we're in balance, right? For $2,000 total sale, we got a down payment of $500 cash and $1,500 in accounts receivable. Number 9, that computer that we just sold cost $1,000. So what did we do? That $1,000 cost, we took out a merchandise inventory and expensed it under cost of sales, under cost of goods sold. Okay, gang, we got a couple more here. Let's keep on doing some more entries here. Number 10, we paid utilities expense in cash. So utilities expense went down, and utility expense went up. It's shown as negative because it's coming out of the business as an expense. So we had a $300 expense in utilities, wrote him a check, cash went down for $300. Number 11, this transaction where we sold the computer, the customer came in and paid $600 on his bill. Yay! So what happens? Cash goes up, accounts receivable that he owed us goes down. Okay. Number 12, the owner feels like he might need some more cash. So look, $2,000 cash, and we went and got a loan and put in liabilities of notes payable we owe the bank for $2,000. And we can see I did a little calculation here. Debit side here is a total of $19,950. Credit side here is $19,950. Okay, there's the tabular column form of the transactions, and we see that we are still in balance. If you'd rather do the journal entry type, let me change this and we'll look at our journal entries real quick. Hi everybody, we're back looking at the same journal entries. The same entries, this time they're a journal entry form. This is probably the way that your software will want you to do it, and this is the more common way that we do accounting, is in journal entries, doing debits and credits. Okay, so let's take a look. Same transactions, okay? Number 1, the owners put $10,000 in the business. Cash goes up, common stock goes up. Now remember, looking at your list of debits and credits, asset is what? A debit increase, liabilities and capital credits increase. So we're still in balance. Cash went up, an asset $10,000, common stock, owner's equity went up, credit $10,000. Okay, number 2, we paid the lawyer, charge it to an asset, organization expense increase, common stock credit increase. Okay, number 3, we paid that $1,000 cash credit, asset goes down. What did we spend the money on? We spent the money on an expense. So an expense, increase in expense is a debit. Increase in an asset, prepaid rent, is a debit. Debits, credits, balance. Okay. Number 4, they bought merchandise inventory on credit. Asset goes up, debit. Liability goes up, accounts payable, credit. Debit and credit, balance. Okay. Number 5, they did advertising expense, paid cash for it. Cash is an asset. Remember, asset. Debit goes up, credit goes down. So cash goes down, $250. Expense goes up, debits and credits, balance. Next one, number 6, advertising expense. Expense, debit goes up. Do they pay for it? No. Accounts payable goes up, liability, and increases of credit. So debit and credits, balance. Number 7, They had $3,000 in cash sales this month. Cash goes up, debit, revenues go up, credit, 3,000, balances. Okay. They sold the computer for 2,000. Revenues go up, 2,000. Cash, asset goes up, 500. Accounts receivable, asset, debit goes up, 1,500. Balances. The computer cost $1,000. So that goes to the expense, cost of goods sold. Take it out of their asset account, merchandise inventory for 1,000. We still balance. Okay. Number 10, they paid their utility bill. Cash, asset, goes down. Credit, expenses, debit, goes up. The customer paid $600 on his bill. Okay. The asset accounts receivable went down because he paid us. So cash and asset goes up, debit, accounts receivable, asset goes down, credit. The owner borrowed some money. Cash goes up, asset, $2,000. Notes payable, liability goes up with the credit. We're still in balance. Okay, by doing the journal entry way, we can perhaps see better that debits and credits balance. So these are doing the transactions in both the tabular form and the journal entry form. Next video, we're going to look at our financial statements real quick. So be sure and watch the next video also. Thanks for watching.